Hello, and welcome back to Reflections on Investing with the Cornell Capital Group. And being a professor of finance and actively involved with the Cornell Capital Group, I'm often asked the question like, is Amazon a good investment for me? Well, you can't answer that question until you understand what the market thinks of Amazon. That is, the first step you have to take is not to look at the company, but at the market. What does the market expect the company to do? How will it perform in terms of future profits? And there are ways mathematically you can get at that, and you can get a notion from the current price what the market thinks Amazon's future is. And then you can compare that with your estimate of Amazon's future. If the two come out the same, then Amazon is not a good or a bad investment. It's just something you might want to hold as part of a diversified index. But if you think the future is much brighter than the market does, that's when Amazon is a good investment for you. If you think it's significantly worse, then that's not the case. So let me give you a specific example that we looked at here at the Cornell Capital Group, which is Peloton. Early on, Peloton was trading at a price of close to $160 a share. By early on, I mean within the last year. And when we did that reverse engineering, we concluded that the market must believe that Peloton's future is astonishingly good. Nothing was going to go wrong. This company was going to take over much of the exercise business. And we didn't think that would happen. So for us, Peloton was a good investment. We thought it was a good investment, but on the short side, because what the market was expecting was far more optimistic than we thought could be achieved. Well, fast forward to the current day. Now Peloton is trading at about $14 a share. It's the same company, but at that price, even though the company faces headwinds, it starts to look like it might be a good investment because the market expectations have collapsed so dramatically. So, to sum up and to introduce today's topic, when you think of an investment, you have to think of it in comparison to the market's expectations. And so one of the first things we try to do at the Cornell Capital Group is reverse engineer the market's expectations. And I'm going to do that today, not in the what is a good investment context, but in the context of Elon Musk's ongoing romance with Twitter, an attempt to purchase Twitter. What does the market think is the probability that Mr. Musk is going to purchase Twitter at his announced price of $54.20 per share? So to introduce that, let's go over to the computer and take a look at some of the background material, like the price of Twitter. And then I'll explain how we can use that. Shown on the screen here is the price of Twitter stock. And it begins on April 1st of 2022. Price was about $39 a share. The next business day, which is April 4th, after the weekend, SEC filings show that Elon Musk now owns 9% of Twitter shares, and the price jumps all the way up to almost $50. Then on April 11th, if we come up here, Musk says that he's going to decline the board seat that he was offered because if he had a board seat, that would place a limit on the number of shares he could own, and he wanted an unlimited number. The next big event is here on the 14th, when Musk offers to buy Twitter at the stated price of $54.20 per share. Then, on April 25th, and there's lots of little things going on other than these big events that I'm pointing to. On April 25th, Twitter agrees to sell to Musk at $54.20, and the stock price reaches its high of about $51.70 per share. And then if we fast forward to May 13th, right before where we are now, the price has come all the way down to $40.72, and Musk has tweeted that the deal is on hold because he believes there are far more bots and fake accounts on Twitter than the company has disclosed. So that's the price history, and the price continues to fall. And part of this fall is due to the overall market decline. That should be recognized. But this is the history of Twitter. Okay, what I've done here is a really rough and ready calculation, but one I think you're going to find interesting. And the idea is that I consider there being two possibilities. Either Musk will buy the company at $54.20 a share, or he won't. And if he doesn't, the stock price is going to drop back to where it was in the days prior to his offer. And if I consider only those two events, and admittedly there are many other things that can happen, but I think this chart's going to tell us about what those things might be. If I consider only those two events, and I know the market price, I can compute the market's estimate of the probability that Mr. Musk will in fact purchase Twitter at $54.20 a share. So on this x-axis here are the probabilities running from 0 to 100%. And on the y-axis, and on the x-axis are the dates. So after the announcement that he owns 9% of the shares, the market's estimate of the probability that he will acquire Twitter is about 78%. So the market's pretty confident that he's going to acquire Twitter at that price. And then over time, that starts to dive. And by April 11th, it's down to only about 35%. Then as it looks like there's going to be a deal, the company is warming up and so forth. And finally, on April 25th, this is where the company agrees to sell to Mr. Musk at $54.20. And the probability rises to 82%. Notice it's still not 100. Lots of things can go wrong. The government may interfere with some sort of antitrust activity. There could be political issues. Mr. Musk is mercurial and he could change his mind and so forth. And then things start to unravel. And one of the reasons they start to unravel is the market is starting to fall. So the $54.20 is looking perhaps more and more dear to Mr. Musk. And we move along, and by May 13th, the probability that Mr. Musk is going to buy Twitter for $54.20 per share has dropped to essentially zero. So rather than argue with the pundits, by just looking at market evidence, we've reached an important conclusion. Twitter is not going to be sold to Mr. Musk for $54.20 a share in the market's view unless something very significant happens. Now that doesn't mean that it won't be sold to Mr. Musk. It just won't be at that price. One of the things the market could be saying is that the price is going to have to be reduced substantially. But that's beyond the scope of this simple analysis that I've done here. But I think it illustrates to you the importance of inferring what the market thinks. And what the market thinks about this deal is that it's not going to happen at $54.20 per share. This has been Reflections on Investing with the Cornell Capital Group. Thanks for joining.